Welcome. Today I'm going to show you a trading strategy that has survived every market cycle. The Golden Cross. It's simple, it's mechanical, and it's been used by professionals for decades. I backtested it on 5 full years of real Bitcoin data, from 2019 through 2024, with strict, repeatable rules. In this video, you'll see the exact code, the signal logic, and the results, trade by trade. So there's no guesswork. If you've ever wondered whether classic strategies still work in modern crypto markets, stay with me. The numbers might surprise you. In this scene, I'll walk you through the structure of the strategy step by step. We start by importing pandas and numpy for working with price data efficiently. Next, we define a trade data object. The point of this is simple. Every time the strategy opens and closes a position, we record the entry date, entry price, exit price, and the profit or loss. This gives us a clean list of trades we can analyze later, instead of relying on charts or memory. Then we build the Golden Cross strategy class. It has 2 key parameters: a fast-moving average period and a slow-moving average period. By default, we use 50 and 200 because those are the classic Golden Cross settings. Now we run the backtest. The engine loads 5 years of Bitcoin candles and calculates the 2 moving averages on every bar. Each time the signal flips, the strategy records a clean entry and exit. When the run completes, we get performance metrics, total trades, win rate, profit factor, drawdown, and overall return. This is the point where ideas meet data. Let's break down real examples so you can see how the strategy behaves. Trade 1, the signal triggers, price trends up, and we exit with a solid profit after a multi-week hold. This is the ideal Golden Cross environment, a sustained trend where the slow filter keeps you in the move. Trade 2 shows the other side. Markets don't trend forever. The position exits with a small loss, and that is a feature, not a bug. The goal isn't to win every trade. The goal is to keep losses limited when the trend fails. Trade 3 and 4 are the paydays. Long holds where the strategy captures a meaningful chunk of the trend without overtrading. And trade 5 is another reminder that pullbacks happen. What matters is the asymmetry. When you're right, wins can be large, and when you're wrong, losses stay controlled by the rules. That's why systematic strategies can outperform emotion over the long run. Here are the headline numbers. Over the full test period, the strategy produced a large sample of trades, which makes the results more reliable. The win rate shows consistency, but the more important part is expectancy. Average wins outweigh average losses. We also look at drawdown, because survival matters more than a single month of profit. The takeaway is simple. The Golden Cross isn't magic, but with discipline, it can be a robust trend system. If you want more videos like this, real strategies, real code, real backtests, subscribe and stay tuned. Comment below with the next strategy you want me to test, and tell me what market you care about: crypto, stocks, or Forex. And remember, one backtest isn't a guarantee of the future. Use risk management, test on your own data, and size positions responsibly. Thanks for watching, and I'll see you in the next one.